Welcome back to another update of Smart Stock Sam. If you are really interested to make money out of US stocks, do not forget to subscribe and tap bell icon. Because on this channel I deliver timely updates before crowd arrives. Alright, here we go. Imagine a company just posted its first ever billion-dollar revenue quarter. They didn't just meet Wall Street's expectations, they obliterated them. Earnings per share? Up 160% year over year. GAAP profitability? 9 consecutive quarters and counting. This should be a celebration, right? Champagne popping? Stock price soaring? Instead, the stock plummeted over 5% the moment the market opened. Welcome to one of the most perplexing market reactions of 2026. And today, we're diving deep into the SoFi Technologies paradox. I'm talking about perfect earnings, brutal sell-off. What's happening with SoFi stock? And trust me, by the end of this video, you'll understand the reasons for this might actually being one of the most compelling opportunities hiding in plain sight. So what exactly happened here? How does a company deliver what analysts are calling a blowout quarter and still get punished by the market? To understand this bizarre disconnect, we need to look at the massive arbitrage opportunity that's forming right now, a gap between record-breaking fundamentals on one side and fearful market sentiment on the other. Let's look at the scorecard. SoFi just delivered what's known in the industry as a triple beat. That means they crushed expectations on revenue, they crushed expectations on earnings, and they even crushed expectations on forward guidance. This is the holy trinity of quarterly reports. We're talking about their 9th consecutive quarter of GAAP profitability. That's over 2 years of consistent, real profits, not just adjusted accounting tricks. Normally, when a growth company posts results like this, you'd expect the stock to gap up. You'd expect analysts scrambling to raise their price targets. You'd expect retail investors piling in. But instead, we hit this critical inflection point where the stock price completely decoupled from the fundamental math. The numbers say one thing, but the market is screaming something entirely different. And here's what makes this situation absolutely fascinating. While these growth numbers look incredible on the surface, there's a hidden mechanic in SoFi's business model that we absolutely need to discuss first. Because it's not just what they're earning, it's how they're earning it that makes this company fundamentally different from every traditional bank you've ever known. SoFi has built what they internally call the productivity loop, and this is the engine that makes everything else possible. Think about traditional banks for a second. When you deposit money at Chase or Bank of America, they're paying you what? Maybe 0.5% interest? But they're charging borrowers 7, 8, sometimes 10% on loans. That spread, that's the so-called banking tax, the premium you pay because these institutions have massive overhead, thousands of physical branches, legacy technology systems that cost billions to maintain. SoFi threw that entire playbook out the window. By owning their entire tech stack through Galileo and Technisys, they've eliminated the banking tax altogether. They don't have to pay licensing fees to third-party processors. They don't need expensive middleware. This vertical integration is their secret weapon, allowing them to offer higher yields to savers, and this is key, while simultaneously offering lower rates to borrowers. Now here's where it gets really interesting. This creates what's called a self-reinforcing cycle. Higher rates attract more deposits. Lower loan rates attract more borrowers. More members on the platform means more data, which improves their credit models, which allows them to price even more competitively. And every single new member becomes a high-margin cross-sell opportunity. One customer might start with a savings account, then add a personal loan, then a credit card, then investments. Each additional product costs SoFi almost nothing to deliver, but adds significant revenue. But that's only half the story. The way they're generating profit is undergoing a massive strategic evolution right now, and this is something most investors are completely missing. Traditional banks make money by holding loans on their balance sheet. You take out a mortgage, the bank keeps that loan, collects interest for 30 years, and bears all the credit risk if you default. It's profitable, sure, but it's also capital-intensive and risky. SoFi is aggressively transitioning away from this model into something much more elegant, a capital-light fintech platform. Look at this trajectory. Fee-based revenue just hit a record $443 million in a single quarter. How? By originating loans for third-party partners instead of holding all the risk themselves. They use their technology, their underwriting models, their customer acquisition engine to create loans. Then they sell those loans to institutional investors who want the yield. SoFi collects fees without tying up capital or taking on the long-term default risk. This is the evolution from traditional lender to platform provider. It's the difference between owning every Uber car versus providing the software that connects drivers and riders. One model requires massive capital and carries huge risk. The other scales infinitely with minimal additional cost. And the chart tells the story perfectly. You can see that fee-based revenue climbing quarter after quarter while they strategically manage their balance sheet exposure. They're proving they can grow income while dramatically de-risking their future. And for long-term investors, this shift is everything. It means more predictable cash flows, higher returns on equity, and significantly less vulnerability to economic downturns. And the diversification isn't stopping there. They're moving into territory that's going to redefine what we think a bank can be. SoFi just became the first nationally chartered bank in the United States to launch its own stablecoin on a public blockchain. Let that sink in for a moment. We're talking about SoFi USD, a dollar-backed digital currency that lives on Ethereum, combining the security and regulatory trust of a traditional bank with the speed and programmability of decentralized finance. They're also relaunching crypto trading with bank-grade security after the industry's reputation took a beating from the FTX collapse and other scandals. And they've introduced SoFi Pay, blockchain-powered international payments that offer fast, low-cost transfers without the ridiculous fees charged by Western Union or traditional wire services. This isn't just following trends. This is capturing a younger, tech-savvy demographic that's increasingly abandoning traditional brick-and-mortar institutions. Millennials and Gen Z don't want to walk into a bank branch. They want to manage their entire financial life from their phone. They want crypto integration. They want seamless international payments. They want technology that actually works in 2026, not technology built in 1996. And SoFi is positioning themselves at the exact intersection of legacy finance's trust and stability with the digital economy's innovation and accessibility. It's a moat that traditional banks can't replicate without spending billions, and fintech startups can't match without the regulatory infrastructure and capital reserves of a national bank. Now, if we dig deeper into the actual numbers from this fourth quarter, the scale of execution becomes absolutely undeniable. The scorecard is nearly perfect. Adjusted net revenue hit $1.13 billion, crossing that psychological billion-dollar threshold for the first time in company history. That's up 37% year over year. Not 5%, not 10%, 37%. For context, most mature financial companies would celebrate 5 to 7% annual revenue growth. SoFi is growing more than 5 times faster. Adjusted earnings per share soared 160%. Think about that number. Their bottom-line profitability isn't just improving, it's exploding. Meanwhile, EBITDA margins are widening, meaning they're not just generating more revenue, they're keeping more of every dollar as profit. They didn't just meet the bar that Wall Street set for them, they cleared it significantly on both the top line and the bottom line. This is what a beat looks like in its purest form. Revenue beat, earnings beat, margin expansion, every single metric trending in the right direction simultaneously. But here's the thing that most investors miss when they look at earnings reports. None of this growth matters if you can't keep customers coming in and keep them engaged. You can have the best technology, the best products, the best margins, but if customer acquisition stalls, growth dies. And this is where SoFi's operational velocity becomes truly unprecedented. They added a record 1 million new members in a single quarter. 1 million people who decided to trust SoFi with their financial lives in just 3 months. To put that in perspective, that's like filling up 10 professional sports stadiums with new customers every single quarter. But here's the real kicker, the metric that separates good growth from great growth. 40% of all new products were opened by existing members. Read that again. 4 out of every 10 new accounts came from people who were already SoFi customers and decided to add another product. This cross-buy strategy is the holy grail of consumer finance because it means they're growing revenue without spending a single additional dollar on advertising for those sales. The customer acquisition cost was already paid when that member first signed up. Now they're just expanding wallet share. A checking account becomes a checking account plus a personal loan. A personal loan becomes a loan plus investments. Investments become the full product suite. The unit economics here are extraordinary. Every additional product per member drives revenue higher while keeping costs essentially flat. This is how you get to 37% revenue growth with expanding margins instead of shrinking ones. This is the productivity loop in action, not just theory, but proven execution at massive scale. So if the internal engine is firing on all cylinders like this, how did each individual business unit perform? Was this a case of one segment carrying the whole company, or was it broad-based strength across the board? It was unquestionably broad-based strength. Let's break it down segment by segment, because the details here reveal just how resilient this business model really is. In lending, they originated $10.5 billion in total loans, up 46% year over year. Personal loans, which are their bread and butter, surged 43%. But here's what caught analysts' attention. Home loans doubled, not grew by 50%, not increased by 75%, they literally doubled. In an environment where mortgage originations across the entire industry have been declining due to high interest rates, SoFi is taking market share aggressively. That's not just riding a rising tide, that's competitive dominance. Financial services revenue exploded by 78% year over year. This segment includes checking and savings accounts, credit cards, and investment products. The 78% growth was driven by strength in their loan platform business, those fee-based originations we talked about earlier, and a 66% increase in interchange fee revenue. Every time a SoFi member swipes their debit card, the company collects a small fee. More members, more swipes, more revenue. Simple, predictable, scalable. Even the technology platform segment, which includes Galileo and Technisys serving other financial institutions, grew 19% despite losing Chime as a major client. Think about that for a second. They lost one of their largest customers and still grew the segment by double digits. That's not luck. That's a diversified client base and sticky, mission-critical technology that other companies can't easily replace. This business is demonstrably resilient across lending, services, and technology. It's not a one-trick pony. It's a diversified financial ecosystem that's winning on multiple fronts simultaneously. So here we are. Perfect execution, record growth, expanding margins, 9 straight quarters of profitability. And yet, the stock got absolutely hammered on earnings day. The question everyone's asking is simple. Reason for this fall? And here's the truth that's going to frustrate a lot of people. The sell-off had almost nothing to do with SoFi's business, and everything to do with forces completely outside their control. Let's start with the macro factors. The same day SoFi reported earnings, the broader market experienced a risk-off rotation. The Dow dropped, the S&P 500 dropped, the Nasdaq dropped. When indices are down across the board, individual stocks, especially growth stocks, get caught in the drift. Algorithms don't care about your quarterly report when they're programmed to sell everything. A hotter-than-expected producer price index report dropped right before the market opened, triggering immediate inflation fears. Investors started questioning whether the Federal Reserve would be able to cut interest rates as aggressively as previously anticipated. And for rate-sensitive companies like SoFi, that kind of uncertainty creates volatility. On top of that, the nomination of Kevin Warsh as the next Federal Reserve Chair introduced even more uncertainty into interest rate policy. Markets hate uncertainty. They can price in good news, they can price in bad news, but they can't price in, we don't know what's coming. So what do? They sell first and ask questions later. None of this had anything to do with SoFi missing expectations or showing weakness in their business. It was a macro storm that happened to coincide with their earnings release. Bad timing, nothing more. But macro wasn't the only factor at play here. there are some technical and structural headwinds we absolutely cannot ignore. First, the dilution overhang. SoFi recently raised $1.5 billion through a public stock offering, which means they issued new shares. In the short term, this creates a temporary ceiling on the price because the market needs time to absorb that additional float. It's like adding more supply to the market without immediately adding equivalent demand. Basic economics says the price will face pressure until that equilibrium is restored. Second, from a technical analysis perspective, the stock broke down from a descending triangle pattern. For traders who follow chart patterns, that breakdown triggered automatic sell signals. Algorithms that execute technical strategies started dumping shares the moment the pattern confirmed, driving the price toward a key support level around $20 regardless of what the fundamental data was showing. Here's the critical insight. Technical traders and fundamental investors are playing completely different games. Technical traders don't care if revenue grew 37%. They care about moving averages, support levels, and pattern breakouts. When those signals trigger, they act. And in the short term, that technical selling can overwhelm fundamental buying. This is the frustrating reality of public markets. Sometimes the price action has absolutely nothing to do with the business performance. Sometimes the market just gets it wrong for weeks or even months before reality reasserts itself. But here's the thing. If you look past today's noise and focus on what management is actually saying about the future, a very different story emerges. SoFi's leadership isn't just confident about the year ahead. They're raising the stakes. For fiscal year 2026, they're guiding for $4,655 billion in revenue and 60 cents in adjusted earnings per share. And here's what makes that guidance so significant. It actually beats the consensus estimates that Wall Street analysts were modeling before the report. Think about the message that sends. Most companies, especially after a volatile market reaction, might sandbag their guidance to make sure they can beat expectations next quarter. They play it safe. SoFi is doing the exact opposite. They're saying, we know the stock got hit. We know investors are nervous. But we're so confident in our trajectory that we're guiding above where the street thought we'd be. They're also projecting at least 30% member growth for the full year, signaling that the customer acquisition engine isn't slowing down. That momentum, adding millions of new members while cross-selling existing ones, that's the foundation of everything we've talked about. And management is telling you point blank, the story is very much intact. But when you stretch the horizon out even further, the targets become truly aggressive. Through 2028, SoFi is aiming for a 30% compound annual growth rate in revenue and an absolutely staggering 38% to 42% compound annual growth rate in earnings per share. Let me put that in perspective. If they hit the low end of that EPS guidance, they'll nearly triple their earnings over the next 3 years. If they hit the high end, they'll more than triple it. They're positioning themselves as the premier compounder in the financial services sector, a company designed to grow significantly faster than legacy banks regardless of what the macroeconomic environment is doing. While JP Morgan and Bank of America are growing earnings 5 to 10% annually, SoFi is targeting 38 to 42%. That's an entirely different league of performance. Now, ambitious targets are one thing. Execution is another, but we've already seen them deliver 9 consecutive quarters of profitability and consistently beat expectations. They've earned the right to be taken seriously when they lay out these growth projections. So if the business is performing this well, if the guidance is this strong, and if the long-term trajectory is this compelling, what is all of this actually worth today? What should you be paying for a share of SoFi Technologies? This is where we hit the truly fascinating part. There's a massive valuation disconnect happening right now. The stock is currently trading in what analysts are calling an oversold zone, between $20 and $23 per share. But major Wall Street firms like Mizuho have price targets at $38. That's not a 10% upside. That's not a 20% upside. We're talking about nearly 100% potential upside from current levels if the stock simply trades up to where fundamentally focused analysts believe it should be. The current price-to-sales ratio is sitting around 6.8 times. For a company growing revenue at 30% annually, expanding margins, and transitioning to a capital-light model, that multiple is historically cheap. You want to know what other fintech and high-growth financial companies trade at? Multiples of 10x, 12x, sometimes 15x sales for companies growing slower than SoFi. Institutions are starting to notice this gap. When you combine a 30% revenue growth rate with improving profitability and a sub-7x sales multiple, you create exactly the kind of setup that value-oriented growth funds start defending. They see a stock trading significantly below intrinsic value, and they start accumulating shares. That buying pressure eventually overwhelms the technical selling we've been seeing. For investors with a multi-year time horizon, the kind of investors who understand that quarterly price movements are just noise, this sentiment-driven dip starts looking like a compelling entry point. You're buying a best-in-class growth story at a valuation that assumes something is fundamentally broken. But nothing is broken. The business is executing flawlessly. The market just isn't pricing it correctly yet. Now, we have to stay objective here. This investment thesis, as compelling as it is not without significant risks. First, execution risk. These aggressive growth targets require near-perfect execution quarter after quarter. If they miss on member growth, if cross-buy rates decline, if fee-based revenue doesn't scale as expected, any of those misses will be punished severely by the market. Growth stocks get rewarded for beating expectations and destroyed for missing them. There's no middle ground. Second, credit performance. We're in an environment where recession fears keep popping up. If unemployment rises and consumers start defaulting on loans at higher rates, SoFi's loan portfolio will take a hit. Even though they're shifting toward a fee-based model, they still hold billions in loans on their balance sheet. A spike in charge-offs would hurt both their profitability and their stock price. Third, the dilution overhang might take longer to clear than optimistic bulls want to believe. That $1.5 billion raise added a lot of shares to the float. Until those shares are fully absorbed by long-term holders, the stock could remain range-bound or choppy. And finally, this company remains highly sensitive to macro factors: interest rates, Fed policy, consumer confidence. Even if SoFi executes perfectly, broader market forces can keep the stock suppressed for quarters. That requires patience and conviction that most investors simply don't have. These risks are real. They're not hypothetical. Anyone investing in SoFi needs to understand and accept them. This is not a risk-free opportunity. It's a high-conviction bet on execution in the face of meaningful headwinds. So what's the final verdict on this opportunity? What's the actual investment thesis here? Here's the big picture. What we're witnessing right now is a short-term technical breakdown clashing directly with a long-term fundamental breakout. In one corner, you have selling driven by macro fears, technical patterns, and dilution concerns. In the other corner, you have a company posting record revenue, exploding earnings, and guiding well above consensus for the years ahead. For traders focused on the next few weeks, this might look like a falling knife. Don't try to catch it. Wait for technical confirmation. But for investors with a multi-year horizon, the kind of people who understand that the best opportunities come when excellent companies are temporarily mispriced, this sentiment-driven dip is exactly what you should be looking for. SoFi is proving quarter after quarter that they can build the future of banking. They're attracting millions of new members. They're cross-selling at rates that traditional banks can only dream of. They're transitioning to a capital-light platform model that scales beautifully. They're innovating in crypto and blockchain while maintaining regulatory trust. And they're doing all of this while expanding margins and delivering consistent profitability. The market just hasn't finished reading the script yet. But eventually, and this is the key word, eventually, price follows fundamentals. It might take 2 quarters. It might take 4. But when the macro fog lifts, when the technical overhang clears, and when the next earnings report reminds investors that this company is special, that gap between $20 and $38 starts closing fast. This is the arbitrage opportunity. Record fundamentals meeting fearful sentiment. And for those patient enough to look past the noise, that's where asymmetric returns are born. If you found this analysis valuable, make sure to hit that like button and subscribe because we're going to keep tracking SoFi's progress through 2026 and beyond. Drop a comment below. Are you buying this dip or are the risks too high for your portfolio? I want to hear your take. Thanks for watching. All right, that's the update. If you want more quick fact-based insight like this, subscribe and tap the bell icon so you don't miss the next one. Drop your thoughts in the comments, and I'll see you in the next update on Smart Stock Sam.